Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Now I would like to introduce you all about my team members in the group for public bank, either for conventional and financial Islamic in public bank. Alright, the first one, I have 6 members, include me. My name is Zaida binti Mat Yunus. The second one, my partner is Syamimi binti Zamzam, Nur Akila binti Muhammad Najib, Azra Farzana binti Rahman Muhammad Arsan, and the last one is Nur Shahida binti Chasni. So now to go the next slide, we get started about what's financing, what I have for financing in a public bank. Now we go through now.
Assalamualaikum and hi everyone. In this video, we will present about housing loan versus housing financing in public bank in Malaysia. My name is Syamimi binti Zamzam. Before we start, I will share a brief overview of public bank origin and growth. Public bank was founded on 6 August 1966 by Tan Sri Datuk Sri Dr. Teh Hong Pyo, with its very first branch located at Jalan Gereja, Kuala Lumpur. His version, it was very simple but very powerful. This is to create a bank for the people, offering accessible financing services to all levels of society. Just 1 year later, in 1967, Public Bank was listed on the Kuala Lumpur Stock Exchange, marking the start of the rapid expansion. Through the 1970s and 1980s, the bank grew its branch network across Malaysia, and by the 1990s, it had extended operation international to places like Hong Kong, China, and ASEAN country. Today, Public Bank stands as the third large bank in Malaysia by asset, offering a wide range of services including personal banking, commercial banking, Islamic banking, investment, and insurance. It is widely recognized for the cost discipline, profitability, and strong reputation for stability. In short, Public Bank's journey from a single branch in KL to a leading financial institution reflect its founders' visions and the commitment to serving both individual and business. Now, I will explain a summary of our report comparing Public Bank's conventional housing loan and Islamic home financing, known as Home Financing I. Public Bank conventional housing loan is based on interest model, offering financing margin up to 90% of the property value with repayment period of up to 35 years. Customer benefit from semi-flexi or full flexi repayment option, withdrawal facilities, and protection through mortgage reducing term insurance or MRTA. This makes the product attractive for borrowers who value affordability, flexibility, and security. On the other hand, Home Financing I is structured under Sharia principle using musyarakah mutanakisah or diminishing partnership concept. Instead of paying interest, customer gradually acquire the bank share of the property while paying rent on the remaining portion. Similar financing margin and tenure are offered, but coverage is provided through group mortgage term takaful or GMTT. This product appeal to customers who prefer ethical and Sharia compliant financing while still enjoy modern banking flexibility. When we compare both products, they have 3 key parameters was stand out. First, rate. Both of conventional and Islamic full flexi financing offer competitive rate at 4.22% per annum, while the Islamic semi-flexi option is slightly higher at 4.52%. Second is fee and charge. Both are customer friendly, with no processing fee or monthly service fee. True penalty applied for late payment and early settlement within the lock-in period. And the last one is insurance or takaful. Conventional loan use MRTA, while Islamic financing using GMTT, ensuring protection tailored to each product.
Alright, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Today, I would like to share you all about what the difference for conventional loan and the financing loan in public bank. Okay, first of all, in public bank Malaysia, conventional loan are interest-based facility where the borrower repay the principal plus interest, while Islamic financing loan offer the true public Islamic bank are Sharia compliant and avoid riba, it means interest, by using a contract such as murabaha, we mean cost plus, ijara, we mean leasing, or musyarakah, mustanikisha, diminution or partnership. Conventional loan provide flexibility with a fixed or floating interest rate but place more risk on the borrower, where Islamic financing theory repayment tangible asset, apply profit rate instead of interest, emphasize ethical risk sharing. For example, public bank offer conventional house, personal and car loans, while public Islamic bank provide personal financing R, vehicle financing R, and home financing R with optional takaful protection. Choosing between them depend on whether you prefer conventional interest-based flexibility or Sharia compliant, predictable profit rate in the financing. Thank you.
This slide explains the criteria used to select financial product. The methodology begins with a structured review of liability requirement to assess borrower suitability. Key factors considered include age, income, stability, and repayment capacity, as these determine a borrower's ability to meet long-term financial commitment. The analysis then distinguishes between conventional housing loan and Islamic home financing, including Sharia compliant structure such as musyarakah, mutanakisah. Finally, flexibility and risk consideration such as withdrawal facilities, lock-in period, and insurance or takaful requirement were evaluated to ensure the product meet borrower needs beyond cost alone. This slide outlines the sources of information used in the study. Primary data was obtained from official bank website, particularly public bank online resources which provided product brochure, eligibility criteria, and update rate structures. Secondary sources, including financial comparison portal, independent review, and case study, were used to benchmark public bank product against competitor. Tertiary sources such as financial publication and Bank Negara Malaysia guideline were incorporated to validate regulatory compliance and responsible lending practice, ensuring the analysis is balanced and credible. This slide explains the parameter used to compare financial product. The comparison is based on three key areas. Number one, interest or profit rate. Number two, fee and charges. And number three, product benefit. Rates were analyzed to assess their impact on repayment over the financing tenure. Fee and charges, including processing costs, legal fee, early settlement penalty, and lock-in period, were reviewed to identify potential hidden costs. And lastly, product benefits such as withdrawal facilities, insurance or takaful coverage, and financing tenure were evaluated in relation to borrower affordability and long-term financial stability.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Syuhada binti Jasni. I am about to present about the product description. The public bank housing loan, conventional. Public bank housing loan is a conventional financing product designed to help individuals purchase residential properties, whether for personal, occupation, or investment purpose. The loan operates on an interest-based structure where repayments are calculated according to the prevailing standardized base rate (SBR) plus a margin set by the bank. Borrowers are offered financing margins of up to 90% of the property value, with an additional 5% available to cover insurance costs. This makes the product accessible to first-time buyers as well as experienced investors who require substantial funding. The loan provides flexible repayment tenures of up to 35 years, subject to the borrower's age and income eligibility. Customers can choose between semi-flexi and full flexi package, which allow them to make extra payment to reduce outstanding principal and withdraw funds when needed. This flexibility is particularly beneficial for borrowers who expect irregular cash flows or want to accelerate repayment without losing access to liquidity. The product also includes a lock-in period, typically 3 years, during which early settlement may incur penalties. Then, insurance coverage is a compulsory requirement under this loan, usually through mortgage reducing terms assurance (MRTA). MRTA protects both the borrower and the bank by ensuring that outstanding loan balance are covered in the event of death or permanent disability. Documentation requirements include proof of income, employment records, property sales and purchase agreements, and EPF statements. Overall, public banks' housing loan is structured to provide affordability, flexibility, and security, making it a conventional yet reliable choice for property financing. Thank you. Okay, next is the product description of public bank home financing I, Islamic way. Okay, public banks home financing I is an Islamic financing product structured under Sharia principles, specifically using the musyarakah mutanakisah diminishing partnership concept. Instead of charging interest, the bank enters into a partnership with the customers to jointly own the property. Over time, the customer gradually purchases the bank share through monthly installment, while also paying rent for the portion still owned by the bank. This ensures compliance with Islamic law by avoiding riba, which is interest, and aligning the financing structure with the ethical and religious value. The financing tenure can extend up to 35 years with margins of financing reaching up to 90% of the property value. Similar to conventional loans, customer can choose semi-flexi or full flexi repayment options, allowing them to deposit extra funds and withdraw later if needed. Profit rates are determined based on the standardized base rate (SBR) plus a margin, and while they function similarly to interest rates, they are structured as profit-sharing agreements rather than debt contracts. This makes the product attractive not only to Muslim borrowers but also to non-Muslim seeking ethical financing alternative. Coverage under Home Financing I is provided through group mortgage, term takaful (GMTT), which replace conventional insurance with Sharia-compliant protection. Documentation requirements mirror those of conventional loans, including proof of income, employment records, and property agreements, and religious compliance, offering customer peace of mind that their financing align with both financial and ethical consideration. Public Bank's Home Financing I, therefore, stands as a competitive alternative to conventional housing loans, combining modern banking features with Sharia-compliant principles. Thank you.
Hi, my name is Azra and I will talk about comparison and analysis in terms of interest rates, fees, benefits, and also terms and conditions. First, from interest rate perspective, conventional and Islamic full flexi are priced equally, and semi-flexi Islamic financing has a slightly higher cost. Then there's a higher rate may reflect added flexibility and structure. Public bank maintains pricing parity between conventional and Islamic full flexi products. Customers can choose Sharia-compliant financing without cost disadvantage. For semi-flexi option, it requires weighing costs and flexibility, especially over long tenure. For fees comparison, for fee type like processing fee, the conventional and Islamic full flexi and also Islamic semi-flexi has non-processing fee. They also have non-monthly service fee, and also for conventional, they have 1% per annum on overdue amount for late payment penalty, while full flexi and semi-flexi has 1% per annum compensation charge for late payment penalty. For early settlement penalty, conventional is applicable if within lock-in period, which is around 3 years. For full flexi and also semi-flexi, they are applicable if within lock-in period. For insurance or takaful, for conventional is under MRTA, which is mortgage reducing term assurance, and full flexi and semi-flexi is under GMTT, which is group mortgage term takaful. For benefits, first for rewards or cashback, for conventional, there's occasional promotional cashback or interest rebates. For full flexi is profits rebates during selected campaigns, same as semi-flexi. Insurance and takaful, conventional is under MRTA, full flexi and semi-flexi is under GMTT. For flexibility, for conventional is semi-flexi or full flexi withdrawal facilities. For full flexi, only full flexi withdrawal facilities. Semi-flexi is semi-flexi withdrawal facilities. Sharia compliance, conventional is not applicable since it's interest based. For full flexi and semi-flexi is full Sharia compliance. For additional benefits, conventional, there's a competitive interest rates and refinancing options. For full flexi, there's an ethical financing structure suitable for Muslim and non-Muslim borrowers. For semi-flexi, there's a flexible repayment with Sharia compliance. For terms and conditions, for repayment period for conventional is up to 35 years, same as full flexi and semi-flexi. Eligibility criteria, there's also the same, which is age 21 to 70, stable income. There's require property purchase agreement. And then lock-in period for conventional is around 3 years. Penalty for early settlement, same as full flexi and semi-flexi. For coverage requirement, conventional is under MRTA, while full flexi and semi-flexi is under GMTT. Flexibility options, conventional is semi-flexi or full flexi withdrawal facilities. Full flexi is only full flexi withdrawal facilities, and semi-flexi is only semi-flexi withdrawal facilities.
Okay, for discussions on this case study, public bank offers both conventional and Islamic housing financing to meet diverse customer needs. So let's look at which product best suit different consumer groups. So the first one is the high income consumers. For high income borrowers, flexibility and liquidity management are key. The full flexi Islamic financing stand out because it allows unlimited withdrawal facilities, which is the customer can deposit surplus funds to reduce the balance and withdraw them rather without the restrictions. It is a Sharia offer group mortgage term takaful coverage and has the same profit rate as conventional loan. This makes it the most attractive option for affluent borrowers who value both flexibility and ethical financing. So the second one is student or low income consumers. For students or low income consumers, affordability is a priority. The public bank 5 home plan, a conventional housing loan, offer the lowest interest rate at 4.22% per annum with processing fees and MRTA insurance, which is cheaper upfront compared to takaful. It also provides semi-flexi repayment options and making it the most cost-effective choice for those sensitive to costs. Third one is frequent travelers. For frequent travelers, minimizing financing costs and maintaining flexibility is essential. Again, the public bank 5 home plan is the best fit with lower interest rates, simpler fees, and affordable MRTA insurance. It frees up disposable income for travel. It is a semi-flexi and full flexi repayment options also help manage irregular cash flows, which is especially useful for those who are often on the move. In summary, public bank diverse housing loan product to ensure the inclusivity. High income consumer benefit most from the full flexi Islamic financing, while student, low income borrower and frequent traveler find greater value in the conventional 5 home plan. This demonstrates how public bank tailors its offering to suit different lifestyle and financial capacities. Okay, so now I will go to the last part of our presentation, which is the conclusion. Okay, housing finance is more than just a numbers. It is about helping individuals and families achieve the dream of home ownership. In Malaysia, borrowers have two main choices, which is the conventional housing loan and Islamic housing financing. Conventional loan offer flexibility with fixed or floating interest rates, refinancing opportunities, and competitive packages. Meanwhile, Islamic housing financing or home financing I emphasize Sharia compliance, transparency, and ethical principle, replacing interest with a profit rate agreed upon at the outset. So for Public Bank, as one of the Malaysia's leading financial institutions, provides both options to meet diverse customer needs. Whether guided by financial goals or ethical values, borrower can choose the best path aligned with their lifestyle. Ultimately, both products serve the same purposes, which is making home ownership possible. Thank you.